Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where we look at the week's financial news. It may be confusing, misleading, and take you off course, fail to make it actual, understandable, and clear. Therefore, what a week and what a show.
What an intro. Bobby Hunt, thank you. Now, Bob, there's a rumor out there that you're going to full-time school next year. Is that right?
Yes.
Will that affect your podcasting career in any way?
Yes.
I was afraid of that. Well, we may just have to talk to the powers that be and ensure that you still get your time on the microphone. We've got a great show. The producers have stepped up in tremendous ways. We're going to be looking at a Wall Street Journal article about the investing heavyweights that back Situational Awareness before it blew up. It's that $45 billion hedge fund run by a 25-year-old wonder child. We then look at a Wall Street Journal article about retirees loving dividends, but the stock market surge is making them think again. Great article. You can't talk about dividends enough. Bob, you remember what dividends are?
Yes.
What are dividends?
Where you get money.
Preach, brother, preach. We had a friend of the show reach out and enjoy your definition of when you get money. So it's the cash payment from a corporation per share. And then we have some fun X.com data. We're going to be talking about just how much financial news has proliferated since the year 2000. Some artificial intelligence papers that bear out what we've been saying for a while now. So the MIT and Stanford set have caught up with us, which I'm grateful for. And then we look at venture capital, how difficult it is to invest in that. But at the top, the investing heavyweights that back situational awareness before it blew up. Subheadline, hedge fund behind aggressive AI bets tapped into roster of big-name investors. Some warned the founder about the risk of heavy borrowing. Now, Bob, do you know what a big-name investor is?
No.
Do you know what a big-name NFL player is?
No.
Yes, you do. What's a big-name NFL player? Like, who's a name of an NFL player that you know?
Patrick Mahomes.
That's a big-name NFL player. Can you name another one?
Dak Prescott.
There you go. So in the investing world, the same dynamic occurs where in the NFL you have these people, these big names, where everybody kind of knows them. Well, in the investing world, we maybe don't know like the NFL, but there are some big names that were behind this $45 billion hedge fund. And what happens, Bob, is people can sometimes think, well, if I just invest with this big name, I'll be good. Or maybe I don't know how to invest, but if I follow whatever this big name does, he'll take care of me. Well, this is a reminder that we can't do that. So these are the big names. Among the fund's investors are Dan Sondheim, founder of the hedge fund D1 Capital Partners and a major SpaceX shareholder. You know what SpaceX is, don't you, boy?
Yes.
What is it?
It's a space thing that the owner of Tesla owns.
Correct. So it's a big deal. He's a SpaceX shareholder. Silicon Valley investor Neil Mehta, co-founder of venture capital firm Green Oaks, the foundation of Gaurav Kapadia, founder of investment firm XN, and Faraz Dewan, the former head of public equities at Tiger Global Management, which is a big name according to people familiar with the matter. Those investors and others signed up for the vision of Leopold Aschenbrenner, Situational's founder. They say he's 24 in this. I thought he was 25, who managed to build a $45 billion investing powerhouse. Here's what happened, Bob. This gentleman, this young man, borrowed heavily to finance his AI bets, and the market moved against him. And have you ever heard the borrower is slave to the lender and the rich rule over the poor? You ever heard that? It's in the scriptures, Bob. So what happened is he left scrambling, and he had to sell just about all of his public stocks to a gentleman named Ken Griffin, another big name at Citadel, another hedge fund. So this guy, who was supposed to be the guy, walked himself into some serious trouble. And there were some other names. Stripe co-founders Patrick Collison and John Collison, and Daniel Gross and Nat Friedman, who lead Meta Platforms' AI efforts, are among Situational's other investors. Wall Street veterans, Bob, were surprised that Aschenbrenner also was able to attract investment from Jane Street, a firm that rarely allocates capital to outside management. So this is a company that almost never does this, but hey, they did it. Now imagine if you were an investor. You were an investor, Bob, and all these big names, you know what a big name is. It's like the Dak Prescott and the Patrick Mahomes of the investor world. They all told you to invest in this thing and it was a can't miss deal. Would that have been tempting to invest in?
Yes.
And why is it so tempting when other smart, wealthy, big names do something and we want to do it too? Why do we want to follow them? Why is that tempting?
Because they did so good.
Because they have a history of success. That's right. So, of course, we want to jump on that bandwagon and see if we might enjoy a little success as they've enjoyed. It doesn't work. And we have to remind ourselves that, listener. Bobby Hunt, you have to remind yourself of that. I have to remind myself of that. You can't just follow people. And I used to think, what if you just followed Warren Buffett? Just depends which decade you followed him. Very difficult to do. And Buffett would even say, don't copy my stock picks. Just buy an index fund. Even though, of course, over his 60 plus years, he's outperformed an index. He says, don't try to replicate it, because people would do that. People would say, oh, Buffett bought, X, Y, Z. But Buffett's had some duds. So if you followed him, you would have to follow him into his duds as well. The answer is still the same. Find yourself a low-cost index fund. Don't worry about the big names. Control what you can. So this article, what it highlights to me, of course, it doesn't explicitly say this, but it communicates to us, don't follow the big names. And I'd like to add, this gentleman, supremely talented, I'm sure, the fund is still up 80% on the year, according to a recent investor letter. It's got a bunch of private investments they couldn't sell or couldn't get a ton of leverage on. That Anthropic being one of them you've probably heard of. But yeah, so they could be all right. It's just they really stubbed their toe where they didn't have to. And the lesson to me, to us is, hey, if it's a big name, there is no name bigger than Mr. Jack Bogle. And we do well to follow the tried and true low cost. So you might hear a big name, I might hear a big name. Don't mean a lot to us, do they? We want to know, what does it cost? Because that's what raises our eyebrows. Oh, wow, it's only 3 basis points, 0.03% to invest in VTI. I'm listening. Tax efficiency so strong that they haven't issued a capital gain in years and years and years. I'm listening. The ability to hold it for a 50-year time period. I'm listening. Simplicity and transparency. I'm listening. No, that's what gets us excited over here at the market update. Not Mr. whatever, a bunch of Leopold Aschenbrenner, who looks like he's done great. Yeah, it's a comet. It's a shooting star. Let it go. Next, Wall Street Journal. This comes up a lot in the personal advisor practice that I participate in. Headline, retirees love dividends, but the stock market surge is making them think again. Subheadline, with the S&P 500 dividend yield near generational lows, chasing income in the stock market is getting tougher. So this article by Veronica Dogger and Shraddha Dinesh, it talks about the dynamic at play, which is that as the S&P 500 has done so well, it has resulted in a lower dividend yield. Now, for my mathematicians out there, you'll recognize that as the price of a stock goes up, if the dividend payment remains constant, the yield, the percentage goes down. Okay, we got some numerator and denominator stuff going on. So that denominator, that stock price, if it goes up, that number gets bigger, and that dividend remains fixed or grows at a slower rate, your yield goes down. It goes down. So this is not just retirees, but predominantly retirees. This article interviews a couple of folks. One 75-year-old retiree, Stephen Yedlin. He historically invested his dividend payouts back in the market, but stopped doing so. He says the yields just aren't very good. What happened is the S&P 500 is up 12.8% this year. So not as interesting to him. And I think this is a financial planner in Spanish Fork, Utah. Never been there. I think this Hiram Smith hits it on the head. He says, what a name, Hiram from Utah. There's a psychological comfort for some in receiving periodic cash payouts rather than deciding when to trim positions or trigger capital gains. I just couldn't agree more. It is absolutely a psychological comfort not to have to do anything. You just, every 3 months or so, you get the cash hits your account. You don't have to trim a position. No capital gains triggered. Mentally, that helps quite a bit. So this gentleman Yeldon shifted into dividend focus ETFs 5 years ago. Helped him. Now, there's typically not going to be outperformance, and there's no free lunch in the investing world. So what I typically see in my own practice is, I'll just buy the highest dividend yielding security I can find, all things being equal, and make more money. And oh, by the way, they extrapolate this line of thinking into these index dividend ETFs or index funds. Great, I'll just do a higher yielding security and that'll be better. There's no free lunch. Almost assuredly, except there was an exception, I think, this past year, almost assuredly you will lag because there will be more cash instead of reinvested in the business. It'll be distributed out to you, and it's ultimately not very tax efficient. So again, this is anomalous, but over the past year, high dividend stocks actually outperformed on a total return basis. The Schwab dividend ETF that before mentioned Mr. Yedlin owned delivered a 31% return compared with a 17.8% return for the low yield Vanguard Morningstar Growth ETF. So it worked, but it's rare. And I like people to think a little differently. I like folks to consider, and it's harder psychologically to be sure, but I want them to consider something called synthetic yield. I'm not sure if I invented this phraseology. I probably didn't. I probably read it somewhere. But synthetic yield is, okay, great. So instead of buying a dividend-focused ETF, dividend-focused index fund, just buy the fuddy-duddy, plain old vanilla VTI, just total market index, mix of growth and value, 3 basis point cost, and look at it and say, hey, at the end of the year, in January or December or January, you simply sell whatever number of shares you need to sell to create yield. So if it yields the paltry 1.5% or so that it may yield in the S&P 500 today, and you need 4%, just sell 2.5%. Now that's that psychological piece. You go back and say, wait, but I don't want to sell shares. And we referenced that with Hiram out in Utah. He said there's a psychological effect. He's right. It's just a better fit to have a simple portfolio that doesn't depend on you rotating into the right dividend ETF. Or what invariably happens is there will be a decade where your dividend focus backfires. And sometimes it happens in a rising interest rate environment. A lot of times when yields and fixed income instruments drop, dividend stocks are favorable, and people look at them and the market looks at them with favor. And great, you did great. But in other environments, it can be brutal to orient yourself to a dividend portfolio. You could just get smoked and underperform the index by a lot. And that's where it's hard. It's very hard to stick with your investing philosophy. Tough to do it. And we want to ensure we have investment portfolios that are 100 years. 100 years. We don't want this short-term stuff. So I'd look at just a normal fuddy-duddy, boring, as boring can be, index fund. And then if you need a little money, you sell a few shares. And that's perfectly all right. It's not illegal. It's not bad. It's psychologically, I understand how it can hurt a little bit, but I think it's a better way to go. And then just some excellent X.com data. This is Mr. Brian Feroldi. He says this. In 2000, and I have not fact-checked him, but I think he's directionally correct. In 2000, there was 1 hour of market news on TV each day. Now there are 16 plus hours. What changed isn't the volume of news, but the volume of noise. Did you hear that? In the year 2000, about an hour market news on TV each day. I'm curious if that's right. Certainly there was less. How's that? Now there are 16 plus hours. I certainly believe that. You can turn it into 24 hours if you want to follow the markets in Asia and Europe and just never sleep. It's the amount of noise. So what I would encourage you, and no one needs to hear this more than yours truly, is find ways to reduce your financial information diet. I have seen more financial mistakes made because people thought they were doing well to listen to every variable, every headline. Believe it or else, AM radio is a synagogue of Satan. Be very careful listening to that. Some of the garbage that I've seen, poison spewing out of that, some of those frequencies, just turn it off. Turn it off. Don't get near it. and guess what? It's not actionable. World's going to keep spinning whether you listen or not. And if the world's going to stop spinning, you listening or watching TV is not going to help you at all. So be willing to just pick up a hobby, find something that doesn't involve you having to watch TV, listen to the radio passively. My recommendation is typically to read the newspaper. That's what I do for this, because at least when you're reading, you've got your own voice. You don't have to deal with the emotions and the vicissitudes of some producer that wants clicks and they want ratings. So do less. No surprise, do less. And then there's an MIT and Stanford paper. They find that most people would be financially better off if they followed the financial advice of LLMs. And they did this on GPT 5.2, which is an old model, and Gemini 3 Flash, old model. They say some people get a bit better advice than others, which largely depends on the questions they ask. The study is called AI Financial Advice, Supply, Demand, and Life Cycle Implications, March 30th, 2026. So we've been saying this on the market update for a bit. Again, happy to have them catch up and do so in what appears to be a robust, rigorous manner. We were doing a little John Wayne over here. Our gut told us this was the case, and they've backed it up. And oh, by the way, these models are far better now than they were in this study. So it's true. You just need to recognize it's true. I tell folks, I have not seen a ton of partiality in these models, and that's why it's going to be better than just about anyone you get advice from. Just about. There are weaknesses, but it's typically the weakness in the quality of question being asked. Just as this study references, the output is sound. I've seen people mess up either not understanding themselves, and they'll bring me, a Gemini or ChatGPT prompt. They've had a conversation with the AI at night, and it's good, but it's sometimes not best for them. But it's still good, and I would still say if they did it, they wouldn't ruin them. It's still good. So don't be afraid of asking questions to even these free models. 3.6 Flash, Gemini is what I use a lot. It's free. It's great. And then we're going to talk a little bit about that velvet rope, that velvet curtain, gee whiz. You want to look behind it and invest like the stars. Here's data on the venture capital industry. Mr. David Sun on the X.com platform. So this less than 40% of venture capital funds have any successful investments. Only 5% of venture capital investors make 90% of the industry's profits. And then there's a little bit of a flywheel thing. He says being a successful investor gets you access to more highly valued startups. So once you're kind of there, it's very tough to break in. So if you've ever wondered or thought, gee whiz, I missed out on SpaceX. That was my rocket ship. No pun intended. Actually, maybe pun was intended. That was my rocket ship. I could have gotten out of orbit and, I don't know, moved to College Station and lived the life I always dreamed of. Well, the probabilities are not on your side. We want to play games where there are lots of winners and it's understandable how to win. The venture capital investing game, or I'd say just the private deal investing game, very difficult. I'm glad to see when data is put together like this. This is from 100,000 different venture capitalists. Blake Jackson and Ilya Strebulev put this together. So a lot of data. There's one thing we focus on here, and no shock. We're going to keep our costs low, our investing simple, and our time horizon long, because that's what's going to give us the best shot on our investing journey.